Hey everybody, this is Paul doing a dividend video. Today is February 29th. Happy leap year for those who celebrate, and or happy leap day. And it's 12:09, and the market is currently open, as you can see. So I guess let's just kind of go over some stuff, see what we got going on, see some thoughts that I have, I guess, for those that are interested. Uh, so this is the portfolio. I don't have this on the screen because for some reason, and I'm going to call Fidelity out on this again, they put your full account number right here, right there, right there, and right there. So I have no idea why they're doing this. It doesn't make any sense. So as you'll notice, so this Fidelity account, as you can see, I've rolled over my IRA to them. The portfolio is finally done, completely rolled over. This is currently the E-Trade portfolio right here, as you can see. And this is all that's left in it. Not very much at all. I'm keeping like maybe one share in there at all, just to kind of keep this thing open. So it's at most is 300 bucks. Um, this is the other account, the Schwab account that I have, just because I was testing out different brokerages. Schwab sucks, by the way. There's just so many things that are wrong with it. It's actually somehow worse than E-Trade, which is actually kind of impressive. Um, I don't know why people use Schwab, to be honest with you. Um, and then we got Fidelity, the king among kings here, where all the money is getting deposited at the moment. I think these numbers are correct. Numbers should be correct. Oh, yeah, that's correct, and that's correct. So as you can see, the current strategy, 123.01, I believe. But the current strategy of basically just rolling over the account, uh, boosting my funds in Fidelity pretty much every day. So I'm taking advantage. I'm taking really, really big advantage of this tax season. I'm putting in a very large amount of hours into like DoorDash and Uber. So as you can see, so right here, 820. Last week alone, I made almost $1,200, and then this week so far, 472. Um, Thursday, Friday, Saturday, and Sunday are actually the busiest days, so that number should go up pretty dramatically. Um, And then I just kind of went in there and messed around with Uber because they had new driver bonuses. So they actually paid me a lot of money just to do 80 orders. So that was pretty nice. And as you can see, I moved over $900. Also, you should see a pretty dramatic difference in the amount that I'm going to post on this video. So the last one I think was 69,701, something like that. And this one is going to end up being 73,692, which is a significant difference. So basically, this is tax return. A lot of this, or a good bit of this, is tax return. So far for the month, I'm not going to hover over the exact thing, but um, basically, I believe it was so far. Let's just give you an example for February. That much is 1675 is DoorDash money. About 1200, I think, 1200 something like that was tax return money, and then another 500 that went to my IRA. So that's tax return, and then the rest of it is just straight up capital gains. February has been pretty amazing actually when it comes to just different things that are going on. So for the month, it's going to look like that, at least depending on what happens today. So as you can see, dramatic difference in terms of, I'm at 43.24 now. This is the portfolio. This is the main portfolio, as you can see. Um, this isn't populated right now because actually Fidelity pays dividends when they're supposed to. Shocker. I know it's real hard to understand that, E-Trade and Schwab, looking at you both. Look, they pay dividends. Oh, so hard. But that's one major advantage of Fidelity. I could do an entire video why Fidelity just completely just stomps their competition. Um, but so that's the current portfolio right now. Everything's completely rolled over. So basically, I have BST targets met, just about. I have dividend reinvesting turned on. O targets are met, BSTZ targets are met, HYG targets are met. So right now, the main focus SPHD and BBN, and then I'm at 357 for dividends, and I'm piling every penny of the DoorDash money in there that I get, and Uber money that I'm in there. So as you can see, because I have the tax return in there helping me, like, give me a little buffer in my checking, I'm able to pile 95% of my profits, so 79%, 95% into the brokerage account. So this is the portfolio currently, as you can see. Current plan is BBN, like I said, now that everything's finally settled, so definitely want to hit these targets. So I guess let's go over the data. I guess the only data that really matters, honestly, is the only data that really matters for anybody is, PCE and, inflation. That's all that matters. What should matter is the simple fact is that home sales are dead. I mean, these home sales are back to where they were at the pandemic lows, which is saying something because that was when it's like 16 million people had lost their, were laid off effectively. Um, you know, homes, it's kind of surprising that we're not in a recession right now because we should be. I mean, our entire housing sector is basically dead. There's people that are talking about. So right now, there's people that are talking about. They're looking at the numbers that just came out. PC is just different things that capture different prices around here, like prices that are going up, that kind of stuff. And the people that want them to like either keep rates the same, the Federal Reserve, or raise rates, are looking specifically at January. And what they're taking away from the chart that you're seeing directly in front of you is that inflation. See this little tick up, that right there, that makes them think we're back to here when we had this situation. So to see this situation where it ticked up and it kept going up, and we have, if this chart doesn't go all the way back to 2022, but it was effectively the same. It was down here actually, and then it went up dramatically as the data caught up. So they're looking at healthcare specifically, which I don't understand why they're looking at that. They should know better. And they're looking at, I believe, what was it, orange thing, other services, like, so they're looking at just different parts of this. So healthcare was specifically a Medicaid contract renegotiation that only happens once a year. And then this is also going to get adjusted down. Like, this number is actually not the final number. This is going to get completely adjusted down in the next coming month. So I think the people that are expecting them to keep rates higher, because they think that rates are going to be higher, there's going to be no cuts for all of 2024, which is insane because your housing sector is completely dead. So that's kind of a problem. So you can't just keep your housing sector completely dead. So that's you can't just do that. So I'm still in the May/June camp. I'm still in that area. I still believe it's going to probably be June because they want to see a year's worth of, as you can see here, they want to see a year's worth of this number coming down. And by June, this should be back to where it's supposed to be. Um, we're still hoping that OER does what it's supposed to do, but I believe I had this here. Um, this does kind of show why the market is like so. On the back end, this is what everybody's waiting on. On the front end, this is what's going on right now. So as you can see, there's really seven stocks that have been driving this market. There's more than that, but I mean the main seven stocks actually have larger market caps, and these are just all the little different countries. South Korea, Germany, kind of thing. So when you add up these stocks here, they have bigger market caps than a lot of actual companies. It's kind of a funny chart to look at. You could pause and kind of look at this chart. It's kind of funny, but I saw that and thought it might be interesting to look at, just kind of see where the concentration in the market is right now. And here is this is a real interesting chart that I found that shows how the expectations for rate cuts shifted as we got closer to where the rate cuts were going to actually happen. So this chart basically shows, it goes from left to right, and then it shows the date ranges of when people's expectations change. So this is pretty much, right now, or actually this hasn't even happened yet, but as you can see, the green line was where they thought originally going into the year. I called this ridiculous. The blue line, day before January payroll report, so February, I called this number ridiculous. It was completely ridiculous. And the arrows are showing what happened. Red line was before the January CPI. So this was the one that was the March cut. This is where everybody thought they were going to cut in March. So that's what you're looking at for the red line right here. And then the blue line is kind of funny because this is what the Fed is actually communicating they plan on doing. And this is as of the 16th, but this is where we're at. This is where we've been basically bouncing in between. So I guess if you can see how my mouse is kind of going like this, the market's been kind of moving like this to price in and out rate cuts. So it's barely moving, but right now the market and the Fed are on the same page. So anything before, say, June, so like if you look at where they expect the first cut, and this is the blue line, so if you draw a straight line down, it's June. I think it's going to be June. The Fed wants it to be June, and if they're able to do it in June, that would be amazing because that would be them cutting when they want to, when they're not forced to. There is a lot of debt out there that's going to refinance in the meantime, and a lot of government debt and a lot of like commercial real estate debt. So hopefully nothing blows up in the meantime. Um, but something would have to blow up where they don't immediately step in. Like the maybe the thing that blows up is this right now, but everybody's watching that. It's always something that just comes from out of nowhere. Maybe like China invading Taiwan. That would drop rates to zero very quickly if that happened. Um, but I think that's kind of where we're at right now. Like I said, the current plan is basically what I said is basically just keep contributing money. And then when rates do move lower, my portfolio should be highly effective just because I'm in very rate sensitive things. Um, so I should see further runs in my portfolio. But I think that's where we're at right now. Like I said, if you have any comments, just leave them in. Just leave them. Be happy to respond to anybody. Thank you so much.